I am so excited about the programs you offer because it really gives a seller of a single family home an out in how to structure taxes so they're not clobbered.
What's the biggest frustration that you're finding with sellers who are looking to relocate that have a ton of equity in their property?
So when I go on listing presentations, the main question I get asked, I don't want to pay capital gains. We've owned this home for 20 years. We paid $149,000. It's worth about $4 million. You know, we don't, that has been the biggest restraint in the Bay Area for many sellers. I've gone into homes where people are actually on walkers. They can't even get up and down the stairs of their home, but they're so concerned about paying capital gains that they refuse to sell their home. So this is a huge issue. This was an issue even before the tight inventory market. So this has been, after meeting you guys, I am so excited about the programs you offer because it really gives a seller of a single family home an out in how to structure taxes so they're not clobbered.
Yeah, definitely. So to that point, right, there's a couple different strategies out there that we can use, right? One of them, obviously, everybody's aware of. It's called the 1031 exchange. But the biggest frustration with the 1031 exchange, for you, Steve, is what?
It's mainly an investment property. So a single family home does not qualify with the 1031 exchange transfer. So it means that you have to have a 2-unit building, you have to have rentals. So it's not applicable to people in single family homes or condo homes.
Right. And that is with the primary residence, right? That is the biggest challenge. A lot of people will get what's called a 121 exclusion, but that's only $500,000 if you're married, yes, or $250,000 if you're single. And I'm assuming, as with Newport Beach, that $500,000 doesn't mean anything.
It means nothing. The price points, most of my clients have multi-million-dollar profits in their homes if they've owned them for 20, even 10, 15 years.
Yeah, absolutely. So, and that kind of, dovetails beautifully into kind of like our next segment, right? The biggest frustration is they feel trapped, 90 years old and they have a walker, right? So what's the strategy? And we're going to kind of just outline that a little bit right now. So the strategy that we like to use is called a deferred sales trust. And what's unique about a deferred sales trust is that any asset that's highly appreciated pretty much qualifies. So it can be a business, it can be a real estate asset, but it can be a primary home, or it can be an investment property. It could be commercial. It could be a stock. There's a lot of tech stocks out there, tech companies that, yep, these kids come in and they develop something and then they IPO and then they're hit and they get, shafted. And so it works with all of these different asset types, including businesses and everything. The primary home is one of the big ones, especially for the affluent areas like we're in, Steve.
Yep, it's true.
Because there's that 500,000, but other than that, there's nothing else for them. And so this strategy allows the person to liquidate the asset, defer all the tax, and then go ahead and reinvest the proceeds into pretty much whatever they want, as long as it's for investment purposes.